the silver price on the edge of a breakout. While gold continues to shatter all-time highs, silver has been lagging behind, but not for long. Right now, we're seeing a convergence of forces that could ignite a major pop-up in the silver price, possibly the biggest in history. Scarce supply, surging industrial demand, and an increasingly fragile paper market have set the stage for what could be a big move. In today's video, I'm going to break down why the silver market is on the verge of a supply crisis, how Wall Street's trading practices are starting to unravel, and why the gold to silver ratio is screaming that silver is overdue for a massive revaluation. We'll also look at industrial demand trends that could drive silver far beyond its previous highs. And finally, we'll discuss just how high silver could go if history repeats itself. So let's get started. For those paying attention, silver has been shifting out of London's vaults at an astonishing rate, but it isn't vanishing. It's being transported to New York, where COMEX inventories are swelling. And this is no small movement. This shift has been driven by an arbitrage opportunity, where silver is priced significantly higher in New York than in London. COMEX silver futures have been trading at a premium over London spot prices. And for traders, this is free money. Ship silver from London, sell it in New York at a higher price, and pocket the difference. The result? Well, a vacuum has been forming in London's silver market. Now, this trend isn't happening in isolation. It's being fueled by economic uncertainty and policy risks. The ongoing debate over US tariffs on silver imports has thrown traders into a frenzy. And even though tariffs on silver haven't even been imposed yet, the mere possibility that they might be has sent ripples through the market. Investors are front-running the risk, closing out short positions and rushing to secure that physical silver. Now, another major warning sign is the spike in silver lease rates. Think of these as the interest rates for borrowing silver. When lease rates climb, it means that there's less physical silver available. And of course, just recently, lease rates in London nearly doubled overnight, reaching levels that traders considered as potential squeeze. If there was plenty of silver in the market, borrowing costs would remain low. And the fact that lease rates soared perhaps tells us that the availability of physical silver has been shrinking rapidly. Cracks are forming in the system. The SLV ETF, one of the most commonly traded silver investment vehicles, has seen its short interest surge, while the number of shares available to borrow has collapsed. Borrowing fees for SLV shares have spiked dramatically in recent weeks, and this is signaling that short sellers are running out of ways to maintain their position. If enough investors demand physical silver, the resulting squeeze could send prices soaring as banks scramble to cover their bet. And that brings us to one of the most overlooked indicators in the silver market, the gold to silver ratio. Now, throughout history, extreme levels in this ratio have signaled major silver rallies, and right now it's been hovering around 90 to 1. Meaning it takes 90 ounces of silver to just equal the value of 1 ounce of gold. And historically, whenever this ratio has climbed this high, silver has just surged in the years that followed. The early 1990s, in the early 2000s after the financial crisis, and again in 2020, silver delivered massive returns when this ratio exceeded 80 to 1. If gold continues its record-breaking run, silver has got a lot of catching up to do. And if the ratio merely returns to its historical average of 40 to 1, silver would need to more than double from these current levels. But if silver truly breaks out, we could be looking at something much bigger. Because here's the catch. Most of the silver that exists in the vaults, or the coins and the jewelry, it's not available in the market. Investors and institutions who hold this physical silver, they're not looking to sell, especially not at today's prices. And so what's the result? A growing imbalance that's really causing some strain in the physical market. Now, at the same time, you've got key players in the global economy who are really trying to accumulate that silver. India, major buyer, with nearly 1 billion ounces they imported just in the last few years. China, securing deals directly with miners, bypassing those traditional supply chains. They are trying to keep silver out of the Western markets. And even Russia, what have they done? They've declared silver to be a strategic asset, adding it to its national reserves. But let's just bring all of this back to basics, like the fact that silver is an actual, tangible, grab it, hold it metal that we want to use. We are facing a structural supply deficit in silver. The Silver Institute has confirmed that we are now entering the 5th consecutive year of a global silver shortage. Silver has been in a supply deficit for many years now, with annual demand outpacing mine production and recycling. And more importantly, the above ground stockpiles that typically would cushion these deficits, they're running low. And of course, all of this is happening while demand continues to soar from industries that rely on silver. They need silver for everything from solar panels to electric vehicles. And of course, that brings us on to one of the biggest drivers of future silver demand, technology. Because silver isn't just this precious metal that we want to hold or store in vaults or wear. It's a critical industrial resource, and while investors tend to focus on its role as a monetary asset, industries are quietly consuming more silver than ever before. And this AI revolution, it's pushing data centers to unprecedented levels of energy consumption. And these facilities, they need these vast amounts of silver in the circuitry, the cooling systems. And meanwhile, the global push for renewable energy, well, that's just accelerating even more. Solar panel production, it's reached record highs. It consumes millions of ounces of silver annually, and that's not going to slow down. And then, of course, there's the wave of battery technology, new solid-state batteries, which could replace lithium-ion batteries and electric vehicles. Well, they may well require even more silver than we're looking at right now. So if that technology scales, it could create an entirely new source of demand, putting even more strain on an already tight market. So this brings us back to paper silver. If there's far more silver that's being traded in paper than actually exists in physical form, then it's estimated that between 4 and 6 billion ounces of silver have been issued as promissory notes, while the actual available physical silver is just a fraction of that. And if a significant number of traders suddenly demand delivery instead of settling in cash, we could see forced buybacks and even outright defaults in the silver market. But of course, the question we're all asking, is silver on the verge of a breakout? Well, many analysts believe so. The forces at play, physical silver shortages, surging industrial demand, market distortions between New York and London, well, an increasing risk of paper silver defaults create this perfect storm for a price surge. And historically, when silver lease rates spike to these sorts of levels we've been seeing, well, price movements can be explosive. And some analysts are already forecasting silver may well hit $40 an ounce by the end of the year. Others are suggesting this could just be the beginning of something even bigger. But how high could silver really go? Well, let's take a conservative estimate based on historical price moves. Maybe silver could hit $50 per ounce in the next 2 years. But if we see a full-scale squeeze, if investors rush to secure that physical silver while supplies are this tight, well, we could see prices pushing beyond $100. And some models suggest that if silver were to reach its inflation-adjusted highs from the 1970s and early 1980s, well, it could be trading north of $200 per ounce today. Now, that might seem extreme, but consider the forces at play. Global silver production is not rising fast enough to meet that demand we just talked about. Industrial applications are becoming more and more critical. Financial institutions that have been trading silver for years are facing increased pressure. And as central banks continue to devalue those fiat currencies, demand for hard assets like gold and silver, it's only going to accelerate. So the setup for silver has never been more compelling. We have a supply crunch. We have increasing industrial and monetary demand, a fragile paper market, and historical indicators, which all may well be pointing towards a breakout. Oh, and there are wars breaking out as well, left, right, and center, within which silver is strategic and critical. So the question isn't whether silver will rise, it's more likely, well, how fast and how far. For investors, the writing is on the wall. Silver is not just a commodity, it is a strategic asset that is becoming increasingly scarce. And if the supply squeeze continues, silver's price action could be unlike anything we've seen in recent memory. And as always, markets can be volatile, but for those who understand what's happening beneath the surface, silver may be presenting itself to be one of the biggest opportunities in the precious metals market today. So the real question is, what do you think? Are you positioning yourself for some real big moves ahead? Let us know in the comments below, and let's keep the conversation going.